My name is Brad Etheridge, and I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. We've got a little over an hour together we're going to spend today. We're going to share some ideas and concept strategies, tell you a little bit more information about our group, the Center for Tax Strategies and Resources, and why people become members. I have the honor now of introducing our main speaker, Simon Singer. For those of you that don't know Simon, he's the founder of the Advisor Consulting Group, and he's been successfully in our industry since 1966. He's written several business bestsellers. He's a very sought-after speaker, and he's been a member of some very prestigious groups, including the Advisors in Philanthropy, and he's the past president of the International Forum, and he's the National Humanitarian Award winner. With that, Mr. Singer, I'll turn it over to you.
Thank you, Bradley. Always nice to hear you lie about me. It's good. So I think we're going to have a good time here today. Let me give you a little background. Brad's right. I started this business in the summer of 1966, frighteningly unsuccessfully. My job was to sell one unit of supplemental retirement income to union employees, and the one unit was $1,000 of whole life insurance that built $600 of cash value once they reached age 65, and I thought that they got both. If you ask me how many sales I made of that particular product, the answer is 0. If you ask me how many presentations I actually made to people, the answer was also 0. And that's really because of the fact that I was dropped down in the area that kind of scared me. So I hid for like 3 or 4 hours until they picked me up again. That is a true story. But over the years, I've been fortunate enough to get successful in this business. And it was attributable to the mentors that I had and the training I received, which unfortunately doesn't exist much anymore in our industry. We've become numbers on a page, and there's no human contact as far as information goes. Discovery has gone by the wayside, and it's which insurance company or assets under management company is lying best about their statistics. So the whole purpose of this is that, as I said, I'm in my 55th year now. The whole purpose is to see if we can start to upgrade the industry and bring it back to where it used to be and have people actually help people as opposed to just sell them something. We develop, if you don't do this correctly, we develop what's called commission breath, and we're going to talk about that in a minute. So let me tell you what we're going to cover today. We're going to discover how to create more net practice income for you, how tax reduction plans, that could be income tax, capital gains tax, gift tax, and estate tax, how tax reduction plans can help business owners and help your practice, tax savings and an income enhancement for W-2 employees and retirees, tax saving is a process versus a product, creating joint ventures with CPAs, tax attorneys, property and casualty companies, and any center of influence. Which strategy to use, why, and how. So, we get overloaded with strategies, but we really have not much idea about how they work and what they do and what's the good news and what's the bad news. But if you create relationships with CPAs and tax attorneys and help show them how you can help them generate revenue, they will teach you. And that's where most of my career came from. Access to resources with experts to help implement. We've got tax attorneys on the faculty. We've got CPAs on the faculty. We've got leading producers in both assets under management and insurance and estate planning on the faculty. They will make presentation and help you out if you need it. How to increase net practice income from qualified plans or IRAs without increasing risk, by the way. How to reduce taxes on retirement plan and IRA distributions. How to turn retirement plans into estate and income tax-free assets. So what is the center? Well, we're an organization that trains, mentors, collaborates, markets, provides access to major resources, and it's basically all about building teams using our resources, and it makes you more than you are if you try to do this on your own. Let me tell you what we're not. We're not an IMO, so you're not required to move your securities license to one of our organizations. We're not an insurance FMO. You're not required to move your licenses. You can run your business through any place that you want to. But if you'll let us help, we can make a really big difference because the intangibles are always the difference. I mean, the reality is we all have the same products, basically. We all have the same tax law. We all have the same strategies. So why does one group of people, top of the table members, forum members, make 10, 20, 100 times more than the average producer? We're telling you it's always the intangibles. And if you'll let us help, if you're making $150,000 a year now, we can get you to $300,000. If you're making $250,000, we can get you to $500,000. The increases incrementally become smaller the more you produce, but there will be increases. If you'll listen, if you'll practice, if we'll do what we do ourselves and add it into your practice. Don't change your practice, add it in. So here's the industry's two biggest problems. Number one is marketing. Where's our next lead come from? Number two is mentoring. My whole practice is probably 10 times greater because of the mentors and the coaches that I paid for and that I was able to create relationships with. So let's talk about marketing first. Let's suppose you're at a party and somebody asks you what you do for a living. I mean, we're all told that we need to have a great elevator speech. I've never seen anybody make any kind of sale of anything in an elevator. So how do you answer that question? What do you do for a living? What do you say? Products and strategies are great, but you don't get to present them to somebody until you have somebody to talk to. So you've got 5 seconds to get 5 minutes in order to get 50 minutes. 5, 5, 50. 5 seconds, 5 minutes to get 50 minutes. In that first 5 seconds, if you don't say anything that will attract them, you don't get the next 5 minutes. And if you don't do the next 5 minutes correctly, you won't get the 50 minutes. So you got 3 choices how to respond. You could say something like, I'm a sophisticated investment advisor. We have the best investment platform in the industry. The client hears blah, 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 because he's heard that 15 times. The next thing you could say is, I specialize in helping people create effective estate plans that minimize estate tax. It's again, blah, 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 blah. Only the problem with that one is that really doesn't take effect until after people pass away. Or you could say, I assist successful business owners and entrepreneurs by reducing taxes in unnecessary capital gains, estate, and income tax. So which one do you think gives you a better chance? I'm an investment advisor, I'm an estate planner, or I can help you reduce your tax. Let me tell you what the problem is. The problem with that is they're going to say to you, are you a CPA? And your answer, if you become a member, your answer is actually, no, I'm not. But what we do is we train CPAs, we train tax attorneys. We're not smarter than they are. We just understand human nature better, and we understand how to speak the English language rather than speak in tax code. So let's see what's next. Once you get to talk to them, you're going to have something meaningful to say if you buy into our method. Let's see, it's not moving. Now I'll get it to move. So the key to access is to talk about what nobody else is talking about, and that is taxes. It's really important to speak to people about taxes because here's a historical perspective. In 1980, the top 10% of the wage earners paid 49% of all the taxes. In 1955, 10% paid 55% of the taxes. In 2000, they paid 66% of the taxes. And in 2015, they paid 71% of the taxes. Now, let me give you a horrible statistic. I'm in California. The state of California is one of the highest, if not the highest, state income tax states that there are. We pay a little bit more than 13% that's no longer deductible against our federal. Well, here's the statistic. We have 35 million people in California. It's a medium-sized country in reality, 35 million people, and yet 66 2/3% of all the state income tax is paid by 35,000 families out of 35 million people. So to think that they are after our clients and our potential clients is an understatement. Here's where taxes are headed. This is kind of a graphic. It shows that the highest tax rate was during World War II of 94%, but even in the 60s and 70s, it was at 94%. A Trump tax dropped it to 37. Obama is now saying 39.6, but if you add 39.6 to 10%, it becomes 49.6 in state income tax, or 13% like California, it becomes 52%. And the average tax rate between 1913 and 2020 is 57%. So we have a $27.7 trillion deficit right now. Do you think it's just possible that changes in Congress and the executive office will suggest that taxes will go up again and again? Let me tell you something. While that hurts my personal income, it also helps my personal income because I have more people to talk to about saving more and more taxes, and it will do that for you as well. So let me kind of read this to you because it's a little small. There's nothing moderate about Biden's proposals for tax to tax high income investors. 2,000 2021, the top individual tax rate for somebody making $400,000 is going to increase to 39% from 37%. Long-term capital gains is going to increase to 39.9. So there's not going to be a benefit in long-term investment on incomes above $1 million. The investment income tax, or the Obama tax, is going to be 3.8, which is not deductible against the Fed or the state, and it's going to bring the total of 39.6.3 plus 3.8 to 43.4. The $23.4 million index estate tax exemption per couple is likely to reduce to $3.5 million, or $7 million per couple, or even $1 million, considering we've got Democratic control of the House, the Senate, and the presidency. And finally, Biden's capital gains taxes will occur at death, meaning you're going to lose the step up in basis. Now, we're not positive of any of those things, but in order to be prepared, we need to prepare ourselves. And this is what's on the street. This is what the tax attorneys and the CPAs are talking about. So the Wall Street Journal commented that although including Biden's 39.6 rate on income, factor in state income taxes, California's 13.3, New Jersey's 10.75. And by the way, there's talk of California state income tax jumping to 16.6 because taxing the rich is a very easy political football. Because if you tell the 34,935,000 people that we have to increase taxes, but we're only going to increase it on those 35,000, don't worry about it. It's not you. It's a simple vote. It's like having two coyotes and a chicken voting on what they're going to have for lunch. The marginal tax rate very well could be in the 60% category. It's important to pay attention to that. All right, heirs desires. These are people between 75 and 99. Those are people that are typically very difficult to do estate planning for, especially when they're over 80, 85, and 90 years old. We've got some strategies that work even when they're 99 years old that help to significantly reduce the tax. We don't have time to talk about it right now, but let me tell you, there are ways to be able to use insurance product to be able to substantially reduce the estate tax and sometimes even get it down to zero. So here are the statistics. Many grandparents have sizable estates and face significant transfer taxes at death. It's often too costly to obtain transfer tax leverage with aging grandparents or in those in poor health. As a result, many grandparents need alternative solutions for transferring their assets generationally. Children and grandchildren often have their own estate planning needs and can benefit from what we call second and third generation planning. Really important to focus in on this because one of those sales during the course of the year can actually make your year. So what's the purpose? The purpose is to produce tax-free growth inside the second and third generation planning. The next piece is to plan provides for liquidity for taxes on children and grandchildren's estate, as well as a reduction in tax on the patriarch. The survivor benefits can be income and estate tax-free. Grandparents' estates will be reimbursed at a much later time. Grandparents' estate will receive tax savings. And then let's discuss how to make money grow and just how important tax saving is. We call this piece uninterrupted compounding. And I don't care what Fisher says or what Susie Orman says or Dave Ramsey says. They are not talking to our client. They're talking to middle America, and their advice for middle America is probably correct. But that's not what really works in the real world, in our market of the upscale people, people with $1 million net worth or more. So let's play a little game. If you took $1 and you doubled it every year for 20 years, how much money do you think you'd end up with? So $1 becomes $2, becomes $4, becomes 8, becomes 16, et cetera, et cetera, et cetera. At the end of 20 years, a single dollar would become $1,048,000. It's uninterrupted compounding, uninterrupted with fees, uninterrupted with taxes. Here's the numbers. It goes from $1, et cetera. You can see down at the bottom, it's $1,048,000. Run the number yourself. Now, I'm not suggesting you can make 100% of your money. I just want to give you evidence of how important the reduction of tax is. Now, let's take the same dollar, do the same exercise. Let's double it every year for 20 years again, only this time, let's subtract 35% for taxes each and every year. So you're really only making 0.65 net, not 1.0 net. How much do you think you'd have at the end of 20 years? Well, the answer is $22,370 versus $1,048,000. That's $977,000 of unnecessary tax if you only learn how to play the game by using some of the resources that we have available. If you learn to understand and communicate this exercise, you'll have an unlimited number of people to talk to because they don't understand it. So here's the table on how those numbers calculate. So how can you reduce taxes for small business? Well, we call it tax reduction plans, and it's one of our tools. So if you want to learn, and by the way, let me back up on this for a second. These tax reduction plans are put together for us. They're fee-based plans. They're put together us by tax attorneys and CPAs to help small business be able to reduce the tax. And the question that's always going to come up, well, I already have a CPA. Well, do you have enough confidence in your CPA to get a second opinion? Because I will tell you, almost always, we're able to get significant deductions and tax savings. I mean, we've had some $90, $100, $250,000 of annual tax savings by things that the CPAs know about, but they don't specialize in, so they don't bother talking about them. Okay, marketing. How do you find the client? That's the key element in our business. Well, there's two key elements. How do I find the client? Number one. Number two, how do I get them to engage? Let's first talk about marketing. How do you find the client? Who do you talk to? Well, you could start with your existing client base. You might have already sold them annuities, insurance, be managing their assets. You might have set up a 401k, but what you haven't done is you haven't talked to them about saving taxes. You might check with existing prospects because now your world becomes far expanded. You might look for wealthy people or business owners who are looking to pay less tax. Owners of qualified retirement plans have some strategies to be able to contribute more and pay tax on less. Doctors and dentists are great targets. We've got a specialized program called the Doctors Academy of Economics that basically works through those. I'll tell you a little bit more about that later. Property and casualty agents. So it basically is anybody that's a center of influence, anybody that has influence with more than a couple of people. CPA practices, major part of my practice. So only this time when you talk to them, you're going to be talking to them with new tools, new words, and new resources, which will elevate your level of respect with them. So how to open the conversation? Here's some questions. Do you know what your largest expense is? Now, a lot of people will say, well, my spousal support, my child support, my mortgage payment, et cetera, et cetera. But if you say to them, well, what about taxes? They'll go, oh yeah, I guess that is my largest expense. I just never thought there was anything I could do about it, so I don't spend much time thinking about things that I can't do anything about. Do you believe taxes are going to be higher or lower in the future? These are questions to ask them. What's your plan to minimize this tax damage? What plans do you have to create tax-free income during retirement? Is your retirement plan self-completing if you become disabled or pass away? Let's see what else we got. Begin with the end in mind. Number one, there are ways to be able to set up huge pension plans far in excess of 401ks, $500,000, $600,000, $700,000 a year, providing that there's not too much money going to the rank and file employees, and there are ways around that issue as well. You set up multi-million-dollar contributions per year, automatically sell life insurance, and gather assets under management, and there's a potential to include post-retirement medical care on a tax-deductible basis. Learn how to do zero tax planning. You've all read that book about zero tax planning. Well, we have them as one of the speakers for high net worth individuals. It works for middle America and below, but there's some real issues as to how do we make it work for high net worth. Learn the language needed to engage clients without talking about products. How about premium financing the way it should be done, meaning minimize the risk? Because talking about, look, there's two things that people don't like. Number one, they don't like life insurance. Number two, they don't like debt. So what is this, an algebra class where if I have two negatives, I turn it into a positive? Understand that people don't like debt and they don't like life insurance. And lo and behold, we come along with premium financing, which combines the two together, and we think they're going to jump at that opportunity. There are ways, well, they will jump, but you have to be certain that you're going to discuss what the negatives are as well. Bring up the objections to begin with. Don't expect to be able to put your head in the sand and that it's never going to come up, because even though they may not say it, they're still going to be thinking it. How to create $2.2 million tax deductions each year for business owners with the blessing of Uncle Sam and gather large assets under management. Learn about a system that automatically creates and adds assets each and every year without looking for new clients. Recapture previously paid taxes. That's what the advantage of these tax reduction plans are. There are ways to recapture previously paid taxes. How to create relationships with professional advisors, CPAs, and attorneys. I'll go into that a little bit more a little bit later. So what is the process for success? Well, number one, it's mentoring. It's the people you associate with. It's resources. You can't know everything, and you certainly can't become an expert at everything. It's learning how to do proper discovery in a conversational fashion. It's not just assets on a page. It's not earnings and taxes and where your assets sit and in what amount. It's what's going on in people's heads and their heart. It means a lot more than what's going on in their pocketbook. And all our industry ever talks about is what's going on with their wealth. Prioritized and signed off on goals and objectives. It's a way to be able to keep people focused. It's a way to do what we call dropping the gate behind them, so if they change their mind, they realize they're changing their mind. By the way, my E&O and malpractice company loves this prioritization of signed off goals and objectives because it establishes a reason and a purpose why I attached a specific product or strategy to a goal and objective that they were not otherwise able to capture. Strategic planning teams, we don't try to do this on our own. We do it in conjunction with their existing CPA, with their existing attorney where possible. And if they need some assistance, we can get them the type of assistance that they need. Attach strategies, I mentioned this before, to goals and objectives that the client not only recognized, but determined that they wanted to do something about. That's the way you get closure. So here's some of the top strategies that can benefit your client and increase your revenue. Create qualified retirement plans. Believe me when I tell you, there's a lot more to qualified retirement plans than doing a 401k where the owner gets to put away, a couple of $10,000 a year. He's not going to be able to retire on 401k. He will be able to retire on defined benefit plans. He will be able to retire on non-qualified plans. How to reduce tax liens on qualified plans. If we ask people who've got on their balance sheet, they've got $1 million in their IRA, and we say to them, how much of that is yours? They'll say $1 million. And you say, wait a second, what about taxes? Oh, well, yeah, okay. Well, so therefore your net worth really isn't the million in that plan. It's more like 400,000 or 500,000. Isn't that true? They'll say yes. Would you be interested in ways of being able to reduce those tax liens on those qualified plan assets? The answer is almost always yes, but with a certain amount of cynicism. How about qualified plan conversion to Roth IRAs without having to take 100% of the tax money out of your pocket? You can do it with 25, 30, 40 cents in the dollar as opposed to 100 cents in the dollar. How to maximize tax-free income. How to maximize after-tax income from pension plans. How to create advanced defined benefit plans which automatically produce assets under management, life insurance, and annuity sales. How about exit strategies for defined benefit plans, profit sharing plans, and IRAs? Exit strategy. Our industry spends all kind of time talking to people about the contribution phase. Well, there's 3 phases of money. The first phase is the contribution phase. The second phase is the accumulation phase. And the third stage, and far and away the largest, is the distribution phase. And nobody talks to the client or the professional advisor about exit strategies. How about exit planning for business owners? One of the tax attorneys that I mentioned before, Joe Strazzeri, is the president of 2 exit strategy locations, one in Orange County, one in Los Angeles, and that's 3, and one in San Diego. It's a different world talking to people about, how are you going to retire? Is your business going to be sold inside or outside, to employees or to strangers? How are you going to price it? How are you going to create a greater value in that business so it sells for a greater amount of money? How are you going to replace the income that you're taking that's both recognized and hidden someplace in your corporation in order to pay all of your expenses? All issues that all business owners are interested in. How about Section 199A? Now, that's a couple of years old now, whereby somebody earning between $314,000 and $414,000 can get an automatic 20% if they're in the certain correct type of business. So it's something that's worth talking about. The CPA knows about it, but if you've noticed, CPAs don't give much prospective advice. They basically put the right numbers in the right boxes and file in the Internal Revenue Service, and they think that they did a great job if there was no audit. That's not tax planning. But they were engaged to do tax planning. The client thinks that not only does the CPA know everything about the tax code, but that they will make recommendations. And I will ask every one of you, when's the last time you ever got a call from your CPA with a piece of prospective advice that saved you income tax? And the answer is almost always never. Almost always never, where your clients are identical. How about S corporations or C corporations or both? There's an arbitrage. The S corporation is taxed at a personal rate. Right now, that rate is 39 and change. The C corporation is 28%. That's 11% positive tax benefits by utilizing C corporations for non-deductible expenses. If you're going to pay tax, at least pay it at a lower rate. Top ideas and strategies continue. How to reduce personal and corporate tax to increase cash flow. If you increase cash flow, you're going to have more money to be able to talk to them about investing or saving or buying insurance or funding retirement plans, et cetera, et cetera. How to use tax savings to produce tax-free income. Think about that. I save, if I make a $100,000 contribution to a defined benefit plan, I save $50,000 and maybe $5,000 of it goes to my rank and file employees. So I have a cost, it's $5,000. I got another $5,000 cost for the actuarial firm. So my out-of-pocket cost is $10,000. But if I had just paid the tax, my out-of-pocket cost was $50,000. Which one would you rather pay? The $50,000 or the $10,000? Backdoor Roth conversions, no matter what your income is. How to use charitable trust and pooled income funds to create large tax deductions to help you fund your Roth conversion. How about mentoring and educational resources? Really important factor here. We provide access to the most creative and successful tax attorneys, CPAs, and financial planners in the industry. And their assignment is to work with you, if you want, educate you, and make you more successful. How about mentoring? I will tell you right now, the people that got me into the Forum 400, the people that got me into the top of the table, they saw some talents that I had, but it was very, very unsophisticated talent. And they took and they upgraded the level of that and helped me become 5, 10, 20 times more successful than I had been. So in mentoring, it's important to be trained in the sophisticated areas of tax law. That's only proactive CPAs and taxis even know about. Or you can use our experts, or you can use our experts in conjunction with their CPAs and tax attorneys. You become much bigger, you become much more important by being a member of a team. You can break into the doctor and dentist market. Our strategic partner, a surgeon of 30 years, can train you how they think, how they process information, and how they make decisions. Really important. You can market to business and property and casualty firms with customized videos and documents to generate interest. We're talking about 1.5 to 2.5 minute little videos that are customized to you. Our name appears no place on them. All of our training, mentoring comes from CPAs, tax attorneys, top of the table, and Forum 400 members. If you will open the door, we can help you close it if you want the help. If you don't want the help, you can still use the information. How about charitable planning in the right words to generate interest? Let me tell you about charitable planning. Most of you are familiar with something called charitable remainder trusts. If you ask a CPA or a tax attorney how many charitable remainder trusts has he ever implemented in their practice, the answer will almost always be less than 5. In many, many cases, it'll be 0. Now that doesn't make any sense. In other words, being able to sell an appreciated asset without having to pay capital gains tax, well, why would I want to pay capital gains tax if I didn't have to? Being able to get an income tax deduction for making a contribution to a CRT is better than making after-tax investments to my own portfolio. Being able to get tax-free growth on 100% of the money as opposed to taxable growth on 50 or 60% of the money, that doesn't make any sense. So the technology of a charitable remainder trust is extremely valuable, and yet most people don't do it. And let me tell you why. This is an opinion. I can't swear to you it's right, but I think there's some words that people must understand they're meeting, or they misinterpret what they think they've heard. Let's talk about a couple of them. Charity, that means to most people, that means I have to give things away. When I give things away, I'm poorer. When I give things away, I lose control. I disinherit my children. So that's not positive. All right, I give things away. I'm poor. I disinherit my children. I'm poorer. I can't change my mind. Well, if we change those words and we start talking about what things do as opposed to what they're called, you'll find a completely different result. We call charitable remainder trust, and by the way, the charitable remainder trust, pooled income funds, charitable lead trust, all different kind of family foundations. They have a place in the conversation whether the people do them or not. So let me change the words. I might say to somebody, did you know that capital gains taxes are voluntary? They'll say no. I said, did you know that estate taxes are voluntary? They'll say no. Did you know that if you opted out of capital gains and estate tax, the government will actually give you a current income tax today just for opting out of those other 2 taxes? Were you aware of that? I get this strange look. Say, I've never heard of that. So wait a second, I'm not done. Thereby, if you set up this series of buckets, not trusts, people are frightened of trusts. If you set up this series of buckets correctly, you'll be able to invest and reinvest exactly the way you want to, and you'll never pay taxes on the gain on those investment assets at all. You'll be able to draw out as little or as much income as you would like. You will pay taxes on the income. It might be ordinary income, it might be long-term capital gain, it might be tax-free, it might be return of principal, but you're still going to have to recognize some kind of income. Were you aware of that? They'll say no. I said, you can actually even become a multi-million-dollar philanthropist supporting numerous worthwhile activities, all under the dictatorial control of your family in perpetuity, and do it all without disinheriting your children. Were you aware of that? Now, all I did was talk about a net income with makeup charitable remainder unit trust, a family foundation, a life insurance policy, and an irrevocable trust, but I used words that people want to listen to, that they don't have any preconceived ideas. They don't like insurance, they don't like irrevocable, they don't like giving things away for charity. If I start talking in their language, then I'm going to get the same results that most everybody else does. If I get them to be interested in the subject matter, there's plenty of time to give them the necessary information for them to do the proper due diligence and make an educated decision. I hope that makes sense. How about understanding the psychology of the engagement? It's not just numbers on a page. Discovery is not just what their net worth is and how much taxes they pay and how old they are. There's much more in between the lines than there is on the lines. Learn why the top of the table producers produce 10 and even 100 times your revenue. Trust me, we aren't 100 times smarter and certainly don't work 100 times harder. We want to share with you that intellectual property in the subjective portion of the sales process that make all the difference in the world. Why do you think you're not able to create relationships and get a continued stream of referrals from professional advisors, CPAs, and attorneys? Well, our CPAs and attorneys are going to tell you why you can't. And we've got a little bit of a menu item on this later on. This is an example of one of the pages of the Southern California Academy, Southern California Institute Academy, which is Joe Strazzeri's think tank, one of the tax attorneys. They've got products, they've got courses, they've got events, they've got quick start videos. But here's an example. It's financial, legal, estate, long-term care, business, real estate, and tax professionals becoming members of SCI in order to acquire access to hundreds and hundreds of digital and live educational events and programs with legal and financial subject experts, high-level technical and practice management education and certification programs for legal and financial professionals. If you want to play in this world, you better start associating in this world. Event partnering and management, a resource center for members, groups, and faculty to search and connect with each other. Here's an example of some of the subject matter. There's personal needs. Every single one of these have slide presentation, handout, and client presentation. There's personal needs. There's retirement needs. There's estate and charitable planning programs. There's business consulting. There's business protection planning. There's executive benefits and employee benefits. There's hundreds of these. And if you don't want to spend the time or you don't want to create the technology to be able to create those, they're prepared for you. All right, this is called non-efficient logic versus efficient logic. A piece of software that we utilize is produced by Innsmark, and it's called Wealthy and Wise. And what we discovered that they didn't know that we didn't know is there are some algorithms in the software that do some very, very interesting examples of things. For instance, what asset should I access at what time and in what amount? It's more than just, can I afford to retire? It's more than, can I afford to make gifts so that my kids can buy insurance or invest assets outside of my estate? There's more, there's more, there's more. This is something that comes at a very, very steep discount. It's about a 50% discount on what you can buy. And we will tell you where you can get all of this stuff if you don't want to become members, but there's some real significant advantages to becoming members. So let's look at efficient logic versus non-efficient logic. So here are the assumptions. We've got a couple that are in their 60 and 65. Their life expectancy is 93 and 88. They need $200,000 net after tax cash flow, indexed for inflation at 3%. Their net worth currently is $6.4 million. Their tax brackets, the yields, the turnover rates are all unchanged in each and every scenario. You're going to have to believe me because we're not going to have time to go through the 100 or so pages. There is a backup on this analysis. So trust me for the time being, everything remains identical. So here's the non-efficient structure. At age 93 and 88, their $6.4 million has grown to $12.2 million. They'd only pay about $616,000 under current tax law. And we strongly believe that this lifetime exemption that is currently $11,700,000 for husband and $11,700,000 for wife, which is scheduled by law January 1st of 2026 to be reduced to about $6,000 each. We strongly believe that it's going to go down to $3.5 million each. The estate tax rate is going to increase from a current 40% to 45, or maybe 50, or maybe 55. And there's even some talk that the lifetime exemption is going to drop to about $1 million each. When I was in this business in the beginning, the lifetime exemption was $600,000. Now it's $11.7 million. Again, it doesn't raise much in the way of taxes, except for those few thousand families in the country. So here's the results. The sum total of all their cumulative income is $8.5 million over all those years, which is the $200,000 a year index for inflation. Okay, let's take a look at what happens if we just let the algorithms and the software solve for which asset at what time and in what amount should we access. All of a sudden, it grows by another $6 million, from 12 to $18 million. Because it's grown and because we haven't done any planning, the taxes are going to be more, $4 million. But the heirs still inherit $3 million more, 14 million versus 11 million, and the cash flow is identical, 8.5 million. Now let's start to do a little bit of planning. All right. We want to increase their income. They aren't terribly concerned with how much money their kids are going to inherit, but they don't want to disinherit them. So we use the efficient structure about what asset to access at what time and in what amount. The estate now grows to $13 million. Kids still get $11 million, but mom and dad got to spend $2 million more, $10.5 million versus $8.5 million. Now let's add an insurance component to this, which is about $66,000 a year. The estate still grew to 13. The transfer taxes now were $2 million, but the family got 18 million. Charity hasn't done anything yet. We're going to do that in a minute, but mom and dad still got $10 million in cumulative net cash flow. And then lastly, let's do a little philanthropic planning in addition to the life insurance, in addition to the efficient structure, which was nothing more than making a testamentary gift of their qualified plan assets. Estate grew to 15 million. Kids wound up paying 673,000 in tax. The net to the heirs was 15 million too. Charity got 4 million. Mom and dad still got roughly $10 million. This is a career maker. If you hear nothing more on this presentation today, go talk to Innsmark about something called Wealthy and Wise. It's really an important factor for your practice, whether you do assets or management, insurance, financial planning, or any of the above. Now, you can acquire doctor and dentist clients. They're not the easiest group to talk to, which is the reason that we associated with Dr. Vicki Rackner. You can see she's written 6 books. She's been quoted in an interminable number of magazines and articles. She's a 30-year surgeon who has specialized in the last 10 years in helping doctors become more efficient, and she's agreed to help us help you learn how to have those conversations. She's available for joint book offerings, for speaking engagements, et cetera, et cetera. Very, very talented woman. How to create alliances with CPA firms, property and casualty firms, assets under management representatives. Let's stay with the CPA Strategic Alliance program we've got right now. Everybody talks about it. I mean, every broker dealer, every insurance company, every IMO, they all talk about having CPA Alliance programs. However, very few of them are very successful at it. Almost nobody has the keys. We've got the knowledge, the experience, the software, and the success that can help make you create a strategic alliance with a professional advisor. Now, this isn't a perfect world. You know, we're lucky if we are successful in 1 out of 10 conversations, but that's a lot better than doing continuing education seminars for 500 CPAs during the course of the year and hoping that one of them will ring your telephone. There is a methodology, and I'm going to share a little bit with you. The psychology of working with CPAs. Number 1, you must be well introduced. That can come from another professional advisor. That can come from a client that they currently utilize. You have to interview them, not lecture them. They don't care anything about you. You have to interview them and find out about them, just like you do with a prospective client, or what you should do anyway. You need to find out what they do and what they don't do, what's working from them, what's missing, what's failed. Don't talk about yourself. Don't talk about your products. Don't talk about how brilliant you are. You need to fit your conversation just like you do with a prospective client. Now, this is a whole session by itself. We call it a pyramid of success, but every single one of these steps could very well be an hour of conversation. So we're obviously not going to do it right now, but I will tell you there's a methodology that works, and there's 99 out of 100 methodologies that don't work. So what do you say to when the CPA asks you, well, what kind of client are you looking for? That's an interesting question, because it could be net worth, it could be income, It could be discretionary income. It could be any number of things. There's no way really to define it. So we created something called Facts, Opportunities, and Results, FOR plan. And here's the table of contents of the one that we have right now, and we're creating them all the time. It could be a pension IRA enhancement. It could be investment alternative estate plan or investment alternative income plan. It could be tax and retirement plans for small business, large business owners, tax and retirement plan, leverage estate plan, terminally ill estate plan, zero estate tax plan, highly compensated employees. Let me show you an example of one, and you'll get the idea. This one is the pension and IRA enhancement plan. Here were the facts. The couple in their mid-60s, $2.5 million in IRA rollover accounts, income of which they would never need. Total net worth about $10 million. They want to maximize the amount of money to their heirs without risk and without invading their current lifestyle. Now, the numbers you're going to see are not current numbers because this is about a 20-year-old example that I'm using right now. There's no need in changing it based on tax brackets and yields because of the fact that they're going to change tomorrow anyway. So just grasp the idea. You understand the facts. Here was the opportunity. They were extremely conservative investors. They were highly disturbed when they discovered that after income in respect of the decedent and estate tax, that their $2.5 million IRA would only be worth $750,000 net to their heirs. $750,000, not $2.5 million. The results were, by using collaboration and creative planning, it gave us the opportunity to substantially reduce the income tax while eliminating the estate tax altogether. The result was $2.4 million out of the 2.5 was now available to go to the heirs without any further tax dilution, $1,550,000 of taxes saved, and $80,000 of additional revenue for our strategic partner. Now, I use this as a way of interviewing a CPA to see how many of these potential clients do they have, so I can answer his question of what kind of client you were looking for. And I can go back through each and every one of these to be able to ask that same question. How many of these do you have? How many of those do you have? And if I've created a level of interest and a level of my business acumen, I will get participation, especially if I've been well introduced. So let me get out of here right now. Here's an example of other tax saving wealth strategies and preservations. We're not going to go through these, but there's legacy IRAs. There's Roth IRA conversions, and it tells you the kind of profile to look through. There's the charitable income tax savings trust, and there's the client profile again. The options qualified plan structure, where somebody's got a lot of rank and file employees, but we've done this for very large medical organizations. The tax deductible charitable retirement strategy with wealth replacement trust, tax deductible medical and dental reimbursement. That's something new for us. It's very intriguing. Private placement variable and variable life and annuities. Liquid asset plans for both income and estate, private insurance plans. You know, those are 831Bs. IRS hates 31Bs. Congress loves 831Bs. How unusual that different areas of our government disagree with each other. In the meantime, it's still something that's workable and viable, and it helps save people taxes. Trust to save high state income taxes. Do you know that if you move your assets to a trust in Nevada or Delaware or South Dakota, the trust pays no income tax on those investment assets? You're still going to pay federal tax. You're just not going to pay, and the assets never left where they were. It's just this receptacle that's surrounding it that basically eliminates state income taxes. People wanting to move assets to the United States, whether they're foreign nationals or U.S. citizens with offshore assets, it's very important that they be able to get those assets back, and there's some very severe penalties if they don't declare them. How about automated video content marketing? You can have access to videos customized to you and your firm for your website, emails, your tablet, for every type of financial transaction, from funding for retirement, retirement distributions, estate and asset protection planning, and buy-sell agreements. It goes on and on and on and on and on. You can market and remarket. Remarketing is the key to marketing. People don't, my daughter is a very successful television commercial actress, and I have watched commercials that she have done 10 and 15 times before I finally realized that she was the one in the commercial, because we tend to turn them off. So consistent, ongoing, high quality professional marketing is really important. And you could do the same thing for your attorney, a client, strategic alliances, because they're looking for new business also. They may say they aren't, but then I go to one of these leads meetings on a Thursday morning for breakfast, and there's attorneys there, there's CPAs there. They're looking for where their next engagement is coming from also. So you'll even have scorecards as to who were the people that watched, what were they interested in, how long did they watch or listen. You can do exactly the same thing as I just said for your professional advisor network, financial planners, CPAs, and their list of their clients and prospective clients to help enhance their revenue. And that's one of the big keys in creating strategic alliances, helping them do what they want to do. Would your prospecting be easier if you had something like this? And it doesn't matter whether it's high net worth individuals or business owners or pre-retirees or post-retirees or 401ks or qualified plans or highly compensated executives or professionals. It doesn't matter. They're all human beings. They all have wants. They all have needs. They all have desires. So if you want to get better, you need coaching and you need mentoring. Our industry is the only industry that thinks we can do it on our own. And yet all great athletes, politicians, and business people have coaches and mentors. Think about that concept. I talked to you earlier about that 90% of my success in my career came because of coaches and mentors. Here's some examples. Here's some famous athletes, Tiger Woods and Kenny Stabler and Jack Nicklaus. They all have coaches as long as they are competing. Business people and politicians have coaches and speechwriters as long as they are in business. It is incredibly important. Here's an example in baseball. You got a batting coach, an infield coach, an outfield coach, a hitting coach, a pitching coach, a base running coach, bench coach, managers, and likewise someone who steals signs. Just a little bit of a message of the Houston Astros. Only our industry thinks that we don't need coaching. That's ludicrous. All right, it's like spend money on new golf clubs, but don't spend money on lessons. The golf clubs don't do the hitting. You and your brain does. The difference between a 250 hitter and a 300 hitter. Let's get the criteria. The difference between a 250 hitter in baseball and a 300 hitter. There's 27 weeks in a season, 6 games per week, 4 at bats or so per game equals 600 at bats. If you get 180 hits, you hit 300 for the year. It results in a $20 million salary and entry into the Hall of Fame. If you only get 150 hits a year, it's a 250 average. Maybe you'll make $2 million, still better than a poke in the eye with a sharp stick, but no Hall of Fame. 30 additional hits per season means 1 additional hit per week, 1 bad bounce hit, 1 time where the infielder bobbles the ball and the scorer credits a hit. The differences are infinitesimal. And that's what we make differences is. We can take you from a 250 hitter to a 300 hitter.